Good afternoon. My name is JB Rousselot. I'm from the class of 1990. And my wife and I, Susan, are both doing our 25th reunion this year. I often say that the best thing I got out of my MIT Sloan education was my wife, because we met here. It's my great honor today to introduce our distinguished speaker, Andrew Law. Andrew is the Charles and Susan Harris Professor and Director of the MIT Laboratory for Financial Engineering. His research focuses on fundamental aspects of investments and financial market, including illiquidity and systemic risks of hedge funds. He has also focused on evolutionary and neurobiological models of risk preference and financial market dynamics, and most recently on new approaches to financial biomedical innovation. Yesterday, Susan and I were catching up with a good friend in research who told us that his most insightful findings were often when he was applying his expertise into a completely different field. And so that's why it's very interesting for me to today hear Professor Law talk about how financial strategy can cure all disease. Please help me welcome Professor Law to the stage.
Well, I'd like to start by thanking JB for that generous introduction. And I want to thank all of you for coming to this session and for coming back and visiting with us. And congratulations on this wonderful reunion. As academics, we have lots of opportunities to give talks. But by far the most coveted opportunities are ones where we get to speak to alumni because of the level of energy that the forums bring. And this is no exception. We're really grateful for your coming here, and also welcome to, for those of you who haven't seen our new building, and thank all of you for supporting that new building. It's been a huge benefit to all of us here at Sloan. So I want to talk today about a rather unusual topic, a topic that I actually have no particular qualifications to speak on. And it's a little bit unusual for me. Typically when I give a talk, I generally know as much, if not more, about the subject than most people in the audience. And today it's definitely not true. I got interested in biomedical innovation really for personal reasons. A number of friends and family were dealing with cancer over the course of the last several years. And in dealing with their situation, I started learning more and more about not only the therapeutics involved, but the business of biomedical innovation. And so some very strange things emerged from that informal kind of investigation. And it started getting me to think about how we can apply finance to these situations. And so what I want to talk to you about today are a couple of the things that we're doing here at MIT in the finance group in terms of research on applying finance to addressing issues like cancer, Alzheimer's, and other kinds of diseases. I'm happy to take questions along the way if you like, but I think most of you are probably a bit too shy for that. So I'm going to try to keep my remarks somewhat shorter and leave plenty of time for Q&A, which by far will be the more illuminating part of this discussion. So let me first start with an observation that has been made by many people, not just me, but biomedical experts, which is that we are now at an inflection point in biomedicine. Literally every week, something is being announced that is an absolute breakthrough in how we think not only about the biology of human disease, but how we can treat it at the molecular level. And perhaps because we happen to be in Cambridge, perhaps because we're fortunate enough to be at MIT, which is one of the leading centers of biomedical innovation, we see this all the time. It's all around us. And I'll give you just one example. A paper was published a few months ago by a colleague of ours just a few blocks away at CSAIL and in bioengineering, an article titled Integrative Analysis of 111 Reference Human Epigenomes. Now, I don't know about you, but that makes no sense to me. I have no idea what that means. I just barely know what the genome is, but the epigenome, that's something that's a little bit more complicated. And as with many of these publications, there are a lot of authors. And in the usual subtle, understated, passive-aggressive way that scientists are, the most important author is the last name on this list, a fellow by the name of Manolis Kellis. Now, I happen to know Manolis. He and I are colleagues at the Computer Science and Artificial Intelligence Lab. And Manolis, here he is, rather young, part of the young generation of bioengineers who is as comfortable with computers as he is in the laboratory. He's been leading this effort on understanding epigenomics. Epigenomics is the field that looks at not just genes, but how genes switch on and off. And in this paper, they report the results of a multiple year-long study where they're able to map these on and off switches to a variety of human conditions. Now, I can't read the paper, but I can look at the pictures. And here's one of the pictures. And if you look at this picture and you just read the labels, you may know nothing about this, as I did. I know nothing about it. But if you read the labels, you read things like chronic lymphocytic leukemia, type 1 diabetes, Graves' disease, celiac disease, rheumatoid arthritis, multiple sclerosis. Biologists are now at the point at which they're developing an understanding of how diseases switch on and off. Now, this is not yet a therapy. It's going to take years before it becomes therapies, but we're talking years, not decades or centuries. In other words, we're close. We've never been as close, and it's at the point where we see remarkable therapies for the most severe human conditions. So in this kind of an atmosphere, you would think that there's plenty of money flowing into biomedicine, and we're taking advantage of these low-hanging fruits that are developing. So it was a shock to me when I learned that actually the opposite was happening. Money was leaving the space, particularly early stage preclinical research, and that it was flowing to other areas, other parts of the venture capital community. Now, that tide seems to be changing over the last year or two, but even so, in terms of the early stage situation, it's worse than ever. So we all know about public funding. NIH budgets have been cut dramatically, not only because of the sequester, but even before that, it's been cut. There's legislation now in Congress that is going to try to reverse that. We don't know whether it'll pass yet. The hope is that it will, but we're really far behind where we should have been and could have been had political situation not turned. But even in the biotech area, which is heating up, and certainly there have been a lot of very visible IPOs, the fact is that the number of biotech VCs has declined, and the bubble may well be bursting. If you take a look at the number of biotech VCs in 2001, there were 201 in the United States, and as of 2013, there was only 137. Now, here in Boston, we happen to be very fortunate because the VCs that are in town are very successful, and they've actually managed to raise more money, but the total number of biotech VCs has declined, and the total amount of assets in biotech VC has gone down. And one of the most disturbing trends is the fact that if you look at the number of firms being started up, Series A funding, that's actually the lowest that it's been in many years. Why? Why is it the case that we seem to be at this inflection point in dealing with disease, and at the very moment when we need funding the most, it's being taken away? And so I have to admit that, as an economist, I look at things through my economic lens. To somebody with a hammer, everything looks like a nail, and I'm guilty of that. My sense is that one of the biggest factors that can explain this rather odd conundrum is the fact that the risks of investing in biomedicine have never been greater. And not only are the risks greater, but the unknown unknowns, which is what economists call uncertainty to distinguish it from risk, the things that you can't even parameterize have also increased. So the fact that you've got increasing risk and uncertainty really underlies this phenomenon of lack of funding at a moment when we can make the best use of it. And it really has to do with risk and reward from a financial perspective. So to underscore this, I'm going to give you two examples of it. The first has to do with a standard investment problem that I give to all of my investment students. So let me start by proposing 4 different investments, and I'm going to ask you to decide which of these 4 you would like. You can only have one of these 4 investments, and what I'll show you in order for you to make your decision is the growth of a dollar invested in this asset, and I'll show you what the performance is of that $1 investment over a period of time. Now, I'm not going to specify the period of time to build suspense and to see whether or not you develop your own intuition for this. The first investment is a dollar invested at this point in time, and it grows to about $2 over a series of many years. $1 investment grows to $2. So not a very exciting investment, but on the other hand, it doesn't bounce around a whole lot either. It's pretty steady. The second investment, this red curve, starts out at $1 and it ends up at over $4, but it's quite a roller coaster ride, up and down. The third investment is even more of a roller coaster ride. You get some really big highs, but some really big declines. But overall, you end up at this investment period at $8. And the last investment is this one. It's much less risk, but it seems to offer a reasonable rate of return. OK, so with your investment hats on, how many people would prefer the green line? Wow, nobody? Bunch of risk takers here. How many people would prefer the red line? Wow, nobody. OK, how about the blue line? Sure, there we go. These are the entrepreneurs, OK? And how about the black line? OK. Sure and steady wins the race, and looks like it's got a great return and relatively low risk. Well, let me tell you what you picked. The green line is an investment in T-bills. The red line is the S&P 500, and I should say the end of this is 2008. The blue line is the single investment in Pfizer stock, and the black line, which most of you picked, is Fairfield Century, which is the feeder fund to Bernie Madoff's hedge fund. Now you know how we got that Ponzi scheme. Look at yourselves. And what happened afterwards? Well, we sort of know what happened afterwards. Human nature. This graph underlies the challenge of drug development. It is incredibly difficult to deal with the risks of a 10 or 20-year drug development project when investors want their rate of return now, and they want it at a reasonable level, and they want low risk. And really, that's the challenge of drug development. You know, it used to be the case that when I thought about developing drugs, I thought of it as a marathon. That is, you know, a very long march from beginning to end, where a company like Pfizer or Merck or Roche takes a preclinical project all the way through phase 1, phase 2, phase 3, FDA approval. It is a long process. In fact, I realized recently that that's the wrong analogy. It's not a marathon anymore. It is now more like an Ironman triathlon. I don't know how many of you know what a triathlon is, but the Ironman triathlon is a 2.4-mile swim, followed by a 112-mile bike race, followed by a 26.2-mile marathon, one after the other. What kind of sick, twisted individual came up with this? This would be me at the beginning line, not the finish line. Actually, out of curiosity, how many people have participated in an Ironman triathlon? Anybody participate in that here? Yeah. Wow. That's really obnoxious. I can't believe you. I mean, people who are able to compete in these events, I don't think they're part of the same species. They're Homo optimus or Homo superioris. That's what it takes to develop drugs these days, because the complexity, the cost, and the hurdles that you have to undergo in order to be able to develop a single successful drug are extraordinary. And partly it's because we're actually getting smarter. Now, in my world of investments, typically when you get smarter, that actually makes your job easier. That reduces the risk, right? The more you know about an investment, the lower the risk. The more you know about a company, the less risky it is. In biomedicine, the more we know, the more risky the financial investments are, because the many paths multiply in terms of what can be done. So let me give you a couple of examples. One example of the increasing complexity has to do with a pattern in biomedicine known as Eroom's law. This was published a couple of years ago in a journal called Nature Biotechnology that highlighted the fact that it looks like the industry has become less productive over time. Does anybody know who Professor Eroom is, who coined Eroom's law? No? Well, actually, there is no Professor Eroom. Eroom is Moore spelled backwards. It's the opposite of Moore's law. Moore's law, as you know, says that we're getting more efficient in producing semiconductors, right? More transistors on a chip. Eroom's law says that if you take the number of new molecular entities approved by the FDA and you divide that by the R&D dollars spent per year, if you take that ratio, it's declining over time. And by the way, this is on a logarithmic scale. So this is really the opposite of Moore's law. Now, I don't think this is an accurate picture of what the pharma industry is doing. I actually think that they are being productive, but it does highlight the increasing costs and complexity of drug development. And here's a simple back of the envelope that I came up with to try to understand how it could be that complexity is increasing over time. And the example that I'll give you is combination therapies. You all know that in many cases, a single drug may not work all that well, but when you combine them 2, 3, 4 at a time, they work beautifully. The HIV cocktail is an example where individually these drugs don't work all that well, but in a cocktail of 5 of these drugs, they turn a death sentence into a chronic manageable condition. So let's do a simple back of the envelope calculation. There are currently 2,800 approved drugs out there. Suppose we took drugs 2 at a time. How many different pairs could we come up with for treating any particular condition? Well, that's simple combinatorics. 2,800 choose 2. The answer is 3.9 million pairs you'd have to search over. And for each one, you'd have to do a clinical trial that costs many hundreds of millions of dollars and would take 10 to 15 years to be able to investigate. That's complexity. And if you're looking at 3 drugs at a time, well, it turns out that now it's 3.6 billion triplets. And if you throw in other characteristics, dosage regimens, and other kind of key statistics, you end up with really an unmanageable combinatorics of disease challenges. And so this is one of the reasons why, as we get smarter, the combinations grow and it becomes more and more challenging to develop drugs. So here's another more specific investment that I've been interested in, which is cancer therapeutics. The basic back-of-the-envelope numbers for developing a single anti-cancer compound is about $200 million in out-of-pocket costs for investigating one single compound from the preclinical stages all the way through phase 1, phase 2, phase 3, and new drug application. $200 million from beginning to end for a single compound. Now, that's not what it costs to develop a single successful drug, because in order to develop one successful drug, you have to try out lots and lots of different compounds. So that's why industry estimates today of what it actually costs to develop one successful drug is about $2.6 billion. So with cancer, $200 million is what it costs to investigate one compound. It takes about 10 years, and the probability of success is 5%. That's why you have to do these multiple trials. If it's 5% success rate, you've got to try 20 compounds to get one success, right, on average. So if you are successful, though, that compound will generate something like $2 billion a year in profits from years 11 through 20, because that's about how much patent life you have left after a 10-year period of this clinical trials process. So $2 billion a year for years 11 through 20 for a $200 million investment in year 0. That gives you a payout of $12.3 billion, which is just the net present value of that stream of $2 billion cash flows from years 11 to 20, discounted at a 10% cost of capital. All right? So that means that either you get a 51% compound annual rate of return on your $200 million investment, or you get nothing, minus 100%. Those are the choices. For my introductory finance students, I have to translate this for them into terms that they understand. So the expected return on this investment is about 12% with 123.5% standard deviation. How many of you would like to invest in this? This is way too risky for most of us. It is far too much concentrated risk in one single investment. But financial engineering can help. We can actually deal with this situation in methods that most of you already know. We can actually use portfolio theory. We can take not just one of these projects, but we can take 150 of them and put them into a portfolio. Now, you might be asking yourself, if I don't want one, why would I want 150 of them? That's like the joke of the two old ladies in the Catskills resort. It's a pretty mediocre resort, and one of the ladies says to the other, the food here, it's terrible. And the second lady says, yes, I know, in such small portions. Why would you want more? The reason, as many of you who took my finance class know, the reason is that you can reduce the risk. Now, it's true you'll need $30 billion of capital. Right? 150 times 200 million. You need $30 billion in order to construct this portfolio. And where are you going to get that? Well, as an economist, I have a very straightforward answer. Let's assume we have $30 billion. I'll come back to it in a minute, I promise you. But if we have $30 billion, what happens then? Well, magic happens. If you assume that these 150 projects are statistically independently distributed, and I'll come back to that assumption and talk about it explicitly, because we're going to relax that assumption. But if you assume that they're independently and identically distributed, each with a 5% success rate, by taking 150 of these projects at a time, 150 shots on goal, to use a hockey term, the probability of at least one or two successes is actually very high. And in fact, if you calculate the expected return of 12% and look at the standard deviation now with 150 of these projects, you see that the standard deviation actually comes down to about 35%. So let me ask you this. How many of you would be willing to invest in a fund like this that offers a 12% return and a 35% standard deviation? Show of hands. Yeah, I've got more takers. We're actually able to raise more money for a project like this. Now, can we really raise $30 billion? The answer is it depends. It depends on the underlying characteristics of the assets that you're trying to do this with. For the assumptions that I just made, 150 projects, 5% probability of success, but if you're successful, you can actually earn $12.3 billion apiece. You can raise a lot of money. And you can actually raise it in ways that typically aren't used for projects like this. You can use debt financing. So let me explain how that is. If you've got 150 projects that are IID with a 5% probability of success, you can actually calculate what the probability is of at least two successes, right? It's a simple binomial distribution. And so it turns out that the probability of at least two successes is 99.59%. It is almost a certainty that you will have at least two successes. And if you have at least two successes, what's your payday in year 10? Well, it's 2 times $12.3 billion, or $24.6 billion. Well, if you've got $24.6 billion in year 10, you could issue 10-year bonds with a face value of, at most, $24.6 billion. And what's the likelihood of default if you issued 10-year bonds at $24.6 billion? Well, the default rate is 1 minus 99.59%, which is about 41 basis points, which puts you into AA rated category for debt, which as of a couple of weeks ago was 2.45%, which means that that gives you today $19.3 billion in cash. So in other words, of that $30 billion that I needed, I can raise almost 2/3 of it by issuing AA rated bonds. And if you allow me to use all the tricks of the financial trade, things like collateralized debt obligations, credit default swaps, tranching, yes, all the wonderful things that gave us the financial crisis, I can do even better. Now, is that really a good idea? Well, you know, at first, I have to admit, I was a bit wary about this. But in fact, it was the financial crisis that got my co-authors and I to start thinking along these lines. Because it's not that these methods didn't work that gave us the financial crisis. It's the fact that these methods, they worked way too well. They pumped tremendous amounts of money into US residential real estate in a short period of time. And they did it in the most natural way by securitizing cash flows. So imagine, if you will, we create a portfolio with drugs that start out at the preclinical phase, and maybe in phase 1 they succeed and they go on, or if they don't, you maybe sell the intellectual property. But if they go on, then you go to phase 2 and phase 3, and hopefully it gets approved. But you don't know that it's going to get approved because, well, there's a lot of risk involved. So you do 150 of these things, and that 150 will, on occasion, give you some cash flows in the middle. But at the end, hopefully, we'll have one hit out of 150, and we know that's very, very likely. And these projects along the way in a portfolio will give us a series of cash flows. And these cash flows can then be used to issue securities. Once you have a set of cash flows, we know that investors are willing to value them and then invest in them. And so if you issue bonds of different sorts and equity, and you pay up front, and what you get as collateral is the intellectual property, what you'll ultimately be able to do is exactly the same thing that we did with mortgages, auto loans, credit cards, all sorts of odd cash flows that may have no bearing on what an investor is interested in, but ultimately produce some valuable payoffs in the end. That's the basic idea. And it's an old one. It's one that certainly is not new to this application, but it's one that actually changes the dynamic in terms of the kinds of assets that you can raise. And it's all based upon the simple principle of diversification, not putting all your eggs in one basket. So the probability curve that really underlies all of these securities is the probability of at least K successes. So what I've shown in blue is the probability of at least 2 successes out of 150 trials with a 5% success rate in each. As I told you, the probability of at least 2 successes is something like 99.59%, assuming no correlation. Now, as we know from the mortgage crisis, what used to be uncorrelated can very quickly become correlated, in which case all bets are off. And we see the same thing here. If the probability stays the same at 5%, but the correlation of success or failure goes up to, say, 10%, now the probability of at least 2 successes is only 96%. Still pretty high, but not as high as 99.59. If the correlation goes to 40%, now the probability of at least 2 successes is 70%. And if the correlation is as high as 80%, now you're getting a probability of 2 successes or more at 30%. At 30%, you cannot securitize anything. Nobody is going to want to buy the debt of that portfolio because of the correlations. And so what's driving all of this is the ability to construct a relatively low correlation set of projects. One of my pharma friends said that, after looking at this analysis, he finally understood what the challenges were in big pharma because they have a very difficult time diversifying in the way that we're describing. And the way he first thought of it was an analogy to his 3rd grade daughter's soccer team. He apparently coaches that soccer team, and he says it's very frustrating. He's actually a pretty good soccer player himself. And so I asked him why it was frustrating. And he said, well, if you've ever coached 3rd grade soccer, you know that it looks like this. The kids, they all crowd around the ball. And you've got to tell them, no, spread out. Don't go to where the ball is. Go to where the ball will be. But it's hard because, well, they want to all get to the ball. When you compare this to World Cup soccer, you see the difference. Everybody is spread out. And the idea behind financial securitization really hinges on the ability to diversify. So I think that's a key theme about how we can reduce the risk. And it's a theme that really pushes against the tradition of focusing on what we are most comfortable with, what we find as a safe route. What we want to do instead is to focus on lots of different projects. Now, one of the most frequently asked questions that I get from this approach is, do we really need $30 billion? Because that's an awful lot of money. And particularly in the area of biotech, that seems just unmanageably large. If you think about the size of the entire venture capital industry in 2013, anybody know what the size of assets were across all the VCs in the United States in 2013? What would you guess? If you took all the VC funds in the US in 2013, you added them up, how much would you get? 50 billion? 100 billion? A trillion? Well, it turns out the number is $193 billion, which to some people seems really large, to others seems like a drop in the bucket. Depends on, I guess, your perspective. But of that 193 billion, how much of that do you think was deployed in biotech? 50%? Half? 10 billion, 30 billion. Try 6.1 billion. 6.1 billion in biotech. So if you want $30 billion, you're not going to get it from the VC community. That's just too big a number. And that's not what VC was designed for. So the fact is, it depends on what the underlying projects are as to whether or not we can raise 30 billion. And my co-authors and I, we started with a simple paper that said, suppose we focused on cancer, and suppose we looked at all the cancer projects that have been done over a period of time, and suppose we funded all of them, kind of like an index fund. And what kind of rate of return could we have expected if we securitized it and used the kind of tools that we did for mortgages and other kinds of financial assets? And a paper that we wrote, published in 2012 in Nature Biotech, showed that you would actually earn some pretty interesting rates of return. On the equity side, 9 to 11%. On the debt side, 5% for the senior tranche, 8% for the junior tranche. That seemed like a reasonable rate of return. Not a rate of return that would get venture capitalists excited, but a rate of return that would get pension funds quite excited. And the scale that you would need for cancer is on the order of $10 to $15 billion to really make a big impact, given where things are today. Now, that's cancer. Over the course of the last few years, we've studied lots of other things and run a number of other simulations. And what we found is that for other kind of diseases, the number is smaller. And for others, it could actually be larger. So for example, for Alzheimer's, it turns out that 30 billion may not be nearly enough, because the costs as well as the challenges are much greater for neurodegenerative diseases. We don't have nearly as many targets. We don't understand them as well. We've got to do a lot more research. The testing takes longer, so on and so forth. But in one area, which is the area that I want to talk to you about today, in one area, we actually discovered that 30 billion was way, way, way too large, that you didn't need that big an amount to make a big impact, nor did you need 150 projects. And that area happened to be in orphan diseases. Now, orphan disease, some of you already know what that is. It sounds like, a disease that nobody cares about. That's not true. The orphan disease is a term that really reflects a legal status. In 1983, we passed the Orphan Drug Act. This is an act that defines an orphan disease as a disease affecting 200,000 patients or less. And you might think that that's not a terribly important designation, but it turns out that there are 25 million Americans that suffer from one kind of orphan disease or another, more than the total number of cancer patients we have in this country. And actually, a number of orphan diseases happen to be pediatric cancers. And because of the miracle of modern medicine, it turns out that many of the large diseases that you might think of have now been designated as orphan diseases. For example, did you know that breast cancer is an orphan disease? Wait a minute, how could that be? 200,000 women get diagnosed with breast cancer every year. 30,000 women die of it every year. Well, it turns out that because of molecular biomarkers where we can do a genetic test and stratify the patient population into a smaller subgroup, we can designate certain classes of breast cancer as an orphan disease, and the drug Herceptin was approved as an orphan drug. So the Orphan Drug Act has done some very important things in accelerating this area, but most importantly from a financial perspective, what we discovered is that orphan diseases, almost by definition, almost by construction, have this property that the success or failure of an orphan drug program is uncorrelated with other orphan drug programs because many of these orphan diseases are caused by random genetic mutations. So unlike mortgages that can actually become very highly correlated when you have a national home market decline, orphan diseases are, from the scientific perspective, uncorrelated. And what we found is that when you have uncorrelated projects and where the probability of success is higher, where the costs are lower, where all of the other features of orphan diseases come into play, actually 10 or 20 projects is all you need. And a couple of $100 million can have a huge impact on not only producing these therapies for desperate population, but in providing very, very reasonable rates of return for investors. Well, that's all fine and good from a theoretical perspective, but these are all simulations. What about in reality? The short answer is we don't know because we don't actually have real live clinical data, but we got the next best thing. Over the course of the last couple of years, we were working on a project with the NIH, the part of the National Institutes of Health focused on rare diseases, known as the National Center for Advancing Translational Sciences, or NCATS. And we published a paper just 3 months ago in Science Translational Medicine with 2 co-authors from NCATS, Nora Yang and John McHugh, and my student David Fanyon, who just graduated this year. And we asked NCATS to share with us their data for the 28 projects they have going on in the area of rare and neglected diseases. So it turns out that NCATS has actually engaged in developing basic science into projects that can actually enter the clinical trials process and eventually venture capitalists can then take on and develop into full-blown drugs. So NCATS has 28 of these projects, and based upon their portfolio, we actually got estimates for what it cost to develop this. We used these expenses as well as valuations provided by a panel of experts, venture capitalists in the biotech community that we asked to volunteer and look at the projects. And we simply did a simulation with their data to see what kind of rate of return we would get. The kind of projects in their portfolio are projects for sickle cell disease, for chronic lymphocytic leukemia, Duchenne muscular dystrophy, and other rare and neglected conditions. And so based upon some simulations from their actual live data, things like they spent $28 million in total development costs. We assumed that they would have spent $88 million acquiring the projects that they ultimately ended up engaging in. Using these numbers, we did a simulation to see what kind of a rate of return their portfolio would have gotten if in fact it was a portfolio. And the answer that we got really surprised us. We found that with some simple debt financing, a senior tranche that paid 5%, a junior tranche that paid 8%, that the rate of return on the equity tranche was a modified IRR of about 22%. That's a fantastic rate of return. Even by venture capital standards, that's actually quite respectable. And so this suggested to us that you could actually use these financing methods in lots of different contexts where currently they're not being deployed. And in addition to developing these life-saving therapies, you could actually make a decent rate of return for investors. So, we didn't know whether any of these numbers made any sense. But interestingly, after we submitted our paper to the journal, 2 of the projects that NCATS had developed were acquired by pharma. And we don't know what was paid because all of that is confidential. And you never really know because these contracts are very complicated. They have milestones and so on. But what we did was the next best thing. We looked at the one-day impact on the stock prices of the acquiring companies on the day that these acquisitions were announced. And here's what we came up with. It turns out that these 2 acquisitions, they had a price impact of about $650 million on the acquiring companies. And the amount of money that was spent developing these projects was about 24 million. And the additional hypothetical cost of acquiring these projects if they hadn't been brought to NCATS was about 88 million. So you're looking at about $100 million versus a $650 million return 4 years later. And these are just 2 out of the 28 projects. They've got more up their sleeve. So this seems to at least underscore the fact that actually these investments are pretty attractive. So this brings me to the main point of my talk, which is divide and conquer. Remember that chart that I started with, this chart from that epigenomic study? This seems to suggest that we are now in a new world of therapeutics, where instead of developing a drug that works for everybody, what we need to do is to focus on subpopulations that have very specific genetic characteristics that we can now identify thanks to being able to sequence the human genome and being able to do that at a relatively inexpensive way. So the idea behind divide and conquer, it's really precision medicine. You've all heard that term. But my interest in it is not from the scientific perspective. I know nothing about the science. The financial perspective is what gets me excited. It used to be the case that we developed drugs for a large patient population by taking a compound and just blasting it out to everybody and seeing for whom it works and for whom it doesn't. And maybe it works for 10% of the population, and maybe it kills 1% of the population because of side effects, and that was considered a good drug and it got approved. Those are the old days. Now, what we can do instead is, starting with the population, we can actually use genetic screening to divide the population into subcomponents. And for each of these different subcomponents, we can develop a better understanding for the molecular basis of the disease. And once we do this and stratify the population, we can then focus on the drug that is the most appropriate for that population. And then we can screen out everybody else. We don't have to blast it out to everybody else. And most importantly, we don't have to worry as much about these deadly side effects. This is where modern medicine is today and where it's going. And from a financial perspective, it's fantastic, because what it does is it increases your diversification, lowers your cost, increases success rates, all of the things that you want as an investor in the portfolio. This is what can be accomplished by using these types of techniques. So divide and conquer is the approach that will ultimately be the most successful from the financial perspective. Knowing nothing about the science, this is what's going to be the most successful. And so the question that I want to ask is, can we orphanize all disease? That's the hope. And I would argue that the probability curve looks very interesting if you focus on the fact that you've got zero correlation and higher success rates for these kinds of therapies. So for example, a 5% success rate with only 20 projects, that's not going to give you a very high probability of at least 2 hits. But if you can get the success rate up to, say, 20%, now you're talking about a 96% success rate for at least 2 trials or more, and then the profits become much less risky. Now, can you really make money on this because these are small patient populations? Well, it turns out that because of the effectiveness of these drugs, there are lots of very, very profitable orphan drugs out there, including, as I mentioned, Herceptin, a breast cancer drug that goes to many hundreds of thousands of patients that has generated tremendous profits. So we can actually do well by doing good. So new business models are emerging. I'm going to wrap up and hopefully have time for Q&A. New business models are emerging to take advantage of these ideas. Something happened a few weeks ago that was very significant. A company in Europe called Malin, they did an IPO on the Irish Stock Exchange and raised 330 million euros. What's interesting about Malin is that this is not a biotech company. It was a company started up by some ex-pharma executives with the express purpose of investing in other companies. In fact, what Malin's going to do is to acquire majority or significant minority equity positions in private, pre-IPO, pre-trade sale operating businesses in the life sciences industry. In other words, they just started a fund and they said, trust us, we're going to invest in good companies, and did an IPO and raised 330 million euros. That is a remarkable achievement. And it's true that the Irish government did put in 50 million euros, but the other monies that were raised were from investors like you and me. Another example of a business model is patient advocacy groups and philanthropists. The Cystic Fibrosis Foundation is an organization that was started up many years ago to deal with this rare disease, cystic fibrosis. It's a genetic mutation that causes dysfunction in your lungs. You develop thick mucus that makes it difficult to breathe. And the typical lifespan of somebody with CF is about 20, 25 years. By that time, you're pretty much gone. Your lungs have to be either, you need a lung transplant, and that doesn't last very long, and you just die. Well, it turns out that the CF Foundation in 1998 decided that they were going to try to help develop drugs by partnering with a pharma company. And so they partnered with Aurora Biosciences, which was eventually acquired by Vertex, a company here in Cambridge. And over the course of 5 or 6 years, they invested $150 million to develop a CF drug. And in 2012, Kalydeco was approved. This drug is the first of its kind that actually treats the disease as opposed to treating the symptoms. It works for about 5% of CF patients, just a few thousand. There are only 30,000 CF patients in the US. This works for maybe 5% of them. That drug was approved in 2012, and the Cystic Fibrosis Foundation invested $150 million, and I say invested, they didn't give the money away. They said, we're willing to put money for this drug if you'll stick with it, but we want a piece of the ownership of the intellectual property. The Cystic Fibrosis Foundation, they ended up selling their interest in this drug just last year. They sold it to a drug royalty company for $3.3 billion. $3.3 billion, which they're now going to take and put back into research in cystic fibrosis. By the way, the company that bought this, Royalty Pharma, they bought this for $3.3 billion. $2.7 billion was financed by a loan, by debt from Bank of America. So these are the kind of things that are going on right now, profitable investments that actually achieve a very important purpose. So let me conclude by asking you, is this realistic? Can we really do it? I don't know. I'm not in the industry, so I'm not qualified to say. But I can tell you that from the financial perspective, from the funding perspective, the money is there. And actually, let me just do a very simple proof of concept to illustrate that to you. Imagine if we created a huge mega fund of this order. And imagine if we got the very best experts in business and in biomedicine to join the advisory boards. And imagine if we got a very reputable fund family somewhere here in Boston to offer a mutual fund that would take these monies and use these advisory board members to invest in the very best possible biomedical projects to save lives. Would you be willing to invest $3,000 of your 401k or your parents' 401k or your children's college education fund? Would you be willing to invest as a one-time investment in this fund, $3,000? Now, before you answer, I'm going to leave you with one final story that might provide a little bit more of a compelling motivation for this. I'm going to tell you about a colleague of mine named Harvey Lodish, who is a professor in the biology department and at the Whitehead Institute. Harvey is a cell biologist, and in 1986, he was approached by a venture capitalist to help develop a drug for a rare condition known as Gaucher's disease. Gaucher's disease is a rare genetic mutation, and if you have it, it makes your body lack a particular kind of an enzyme, and so you have to replace that enzyme in order to deal with this challenge. And in 1986, Lodish was engaged by VC to help develop that enzyme replacement therapy. In 1992, they succeeded and got the drug approved. And they started a company. You might have heard of the company. It was called Genzyme. And Harvey did well. The company did well. The patients did well. But that's not the end of the story. I got to tell you that when I first heard the story, I decided I want to be Harvey Lodish. And let me tell you why. It's because in 2002, 10 years after this drug was approved, Harvey's daughter became pregnant with her first child, Harvey's first grandson. And in utero, this child was diagnosed with Gaucher's disease. Now, even though you have the mutation, it doesn't mean you'll get the disease. You have to wait till you reach puberty to see whether or not the disease manifests itself. And in 2012, Andrew, when he turned 10, did develop Gaucher's disease. He's just fine, thank you very much, because of Grandpa's drug. And when Lodish developed this in 1992, his daughter wasn't even pregnant. She wasn't married. And it's the most amazing thing. And when I hear the story, my first reaction is, I want to be Harvey Lodish. I'd like to be able to develop a drug for my children and grandchildren. But I can't. I don't have a PhD or an MD in biology. But I can if I invest in a fund that develops these cures for my grandchildren. So now let me ask you, how many of you would be willing to invest $3,000? Yeah. You see, we have the assets. The money is there. What we don't have is the structure, the vehicle, the proper financing to be able to do it. With the proper financing, we can cure all disease, but we need to be able to structure it in the right way. And with your help, with the help of the MIT, with the help of the Boston biomedical community, I believe that in our grandchildren's lifetime, we will be able to do that. Thank you. I think we have time for some questions and comments. Here, sir. Yes.
Thank you. That was very inspiring. But we have one huge problem with the current industry structure. We say big pharma. According to what you just said, it would imply that we should decouple the commercial side versus the research side. The reason I say that is because all of big pharma is saying we are going to focus on so many therapeutic areas, and that makes a lot of sense on the commercial side. But maybe the next logical step would be decouple R&D and commercial, and then fragment R&D to reduce the correlation, if you will. And that could be funded by venture capital and have research and development happening everywhere, academia, startups, and so on.
Yep. So first of all, let me say at the outset that I'm not qualified to answer that question. I'm not part of the industry, and it would be the height of arrogance and presumptuousness for me to do that, which doesn't stop most economists, by the way. But let me channel some of my more knowledgeable pharma colleagues and say that you're absolutely right. The industry does need to change, and the pharma companies themselves acknowledge this. But they're changing in ways that you may not agree with. In particular, big pharma is focusing on later stage drug development as opposed to earlier stage R&D. So they are trying to decouple it, but the way they're decoupling it is by cutting their R&D and essentially outsourcing or in-licensing these kind of compounds. Now, the reason that might make sense, and it gets to the diversification point, is that the science of drug development is becoming harder and harder. And so no one organization, no matter how successful it is, no one organization is going to have the smartest, the best, all of the necessary people on their staff. So more likely than not, the next breakthrough that comes for Alzheimer's or diabetes or cancer, the next breakthrough is not going to be from your company. It's going to come from some university somewhere in the middle of nowhere, and it's because it just so happens that there's scientists there that made that breakthrough. So we've got to figure out a way to supercharge that aspect, and there's where universities play a huge role, and where philanthropy can play a huge role, and where the government is currently not playing as big a role as it could and should. So I think that really underscores your point that we have to reinvent the industry, and I believe it's happening. But I think we can do a lot more to accelerate that by providing the kind of financing to make that happen sooner rather than later.
Pass that down to the gentleman.
Thank you, Professor Lowe. I think this is great. But I have one question, one concern. I remember about the 2008 crisis, and we saw how this very similar system blew up in an area where there seemed to be much less uncertainties, as you put it today. So I would like to relate those two concepts, the risks and uncertainties, and I do see that in this area, the uncertainties are way larger. So I would initially say there are good chances that this, even if it starts working, and we do it in this fashion through highly levered corporations with a larger number of uncertainties in this system, it could one day blow up. So is there any other alternative, like lever them a little more? But I honestly think it's a great idea, but I'm concerned on repeating the vehicle that blew up something.
Yes, so I share your concerns, and actually, when writing these papers, I actually spent a fair bit of time thinking about whether or not it made sense to write about this at all, because do we really want to create another bubble? And so I had 3 ultimate conclusions that I came to, and I share them with you, and I'm still revising them, so I could well be wrong and change my mind. The first is that it's exactly as you said. The risks and uncertainties are greater here than in mortgages. And actually, I think that that's a feature, not a bug, meaning that I think that that's what's ultimately going to keep less money flowing into this than in mortgages. It's because people thought they couldn't lose. They couldn't lose money because real estate kept going up, up, and up every year, that there was no risk. And so that's where all the money came, and that's why we ultimately went overboard. I think there's less of a chance here, precisely because of the risks and uncertainty. So that's one. The second response is that I think we've learned a lot from the mortgage crisis. And so I think that we've put in protections that may reduce some of those concerns. It may not eliminate them, but in effect, it's not possible to eliminate all such risks, even bubbles. We can't eliminate them because that's sort of the nature of innovation. We don't know exactly what the right amount of investment is. And so the third conclusion that I came to is that we may very well have a bubble in cancer research or rare diseases and so on. And if we do and we end up over-investing and producing too many cures, I can sleep at night. I'll be okay. So, yes. Last question, sorry. Yes, in the middle. If you can hand him a mic.
Sure. You hear this time?
So I actually have run a triathlon, I think, because I've been at Pfizer for 25 years.
Congratulations. There's a microphone.
So I guess one part that I wonder whether your solution helps to rationalize is, so we came off a decade like from 2000, 2010 where productivity in the industry basically plummeted.
Right.
It was very low, and while it's recovering, I'm not sure if people are jumping up and down saying that we should be putting more money, and it's probably related to your last question. Certainly our investors are not asking for us to invest more money in R&D. So I'm not sure that we currently have a capital issue.
Right.
It's more of an issue of what's the right level of investment for each firm to make given what we see as the returns going forward. So does your model kind of manage that, or is it just?
It does. It does in the sense that it recognizes that you actually need to have an entire ecosystem working properly in order to get the most out of these various different kinds of breakthroughs. And so you mentioned a very good point. Pfizer actually has $36 billion of cash on its balance sheet today. And of that $36 billion, $31 billion was financed by long-term debt. So actually, Pfizer looks like one of these funds. But what we shareholders have been telling Pfizer and other drug companies is lower your risk, increase your profitability, reduce your expenses. And pharma companies have been listening. They've been cutting their R&D, cutting the expenses, and their profitability is coming back, not to where it was in the 1990s, but certainly better than that lost decade between 2000 and 2010. It's because drug development has become a much more complex process. Drug companies are very, very good at the later stages of phase 2, phase 3, and NDA and marketing and distribution. Drug companies have been very successful in navigating the rocky shoals of regulatory approvals, marketing and distribution, and so on. What no drug company is good at nowadays is the early stage R&D, simply because it's too complicated. There's too many things going on. It's happening too quickly, and the breakthroughs are occurring at points that you can't really identify. So from the shareholder's perspective, what we tell pharma is wait until these breakthroughs have been de-risked, and then you can acquire the companies after they reach phase 2 or so on. So pharma companies are doing what they're being told to do. They may not like it themselves because they feel like they're getting out of the drug development business and getting into the drug M&A business. But it's a challenge. What we need to do with that challenge is to focus on the earlier stages where there isn't the capital that there is in the later stages. So you're right, drug companies have plenty of capital. But what they're not doing with the capital, because us shareholders are telling them not to do it, they're not putting it in early stage R&D. Instead, they're doing acquisitions. What we need to do is to get the capital to the early stages. And with these kind of financing methods, and with your help, I think we can do that. Thank you.